Hello, everyone. This is Howard Klein. Welcome to CREtV Live. Today's edition is January 11th, 2021. It's our first live stream of the year. Let me tell you a little bit about what we're going to be talking about today. First thing I want to mention, if you stay on the show live, you'll have the opportunity to answer a trivia question where, if you're the first person to answer the trivia question live and you are on live when we award the prize, you'll get a $25 Starbucks card. Barbi Reuter is one of my guests. I have interviewed Barbi a number of times, and she is going to give us an office update, which probably will include some mention of COVID-19. Aaron Weiner, he will be giving us a retail and industrial update, and Douglas Dowell will give us an update on interest rates. Reminder, and I'm gonna figure out how to do this. Oh my goodness, I knew that I would mess something up. I want to tell everybody that you should register for my YouTube channel, and I'm trying to find it right now, and I'm trying to find that subscribe button. It's somewhere here. Let's see. Oh no, that's not it. Okay, that was the wrong button. In any event, please hit the subscribe button if you're watching this on YouTube, and there's a little bell which will give you an opportunity to get my updates in advance. So now, let me talk a little about some of the instructions we're going to be doing. You will need, I started with the wrong one, and that's what I was supposed to talk about. And there's the button. I should have started in the beginning. All right, you will have an opportunity to put comments on the comment area. Please do so. So if you can, start with telling us where you're watching this from, if you're watching this live. And later on the show, we'll get to the comments and questions. Also, although I'm an attorney, I'm the only attorney on this show, we're not giving legal advice. So, if you're uncomfortable with that, I recommend that you go seek advice of counsel in your local jurisdiction. Myself, I'm only licensed in the state of California. Okay, let's move on. All right, so now let me introduce everybody. Let's start out with, and I'm going in reverse. I have really not done that. Let's start it with Barbi Reuter. I've known Barbi. I think that I've interviewed Barbi, I don't know, 3 or 4 times. When I think I first interviewed Barbi, she was, I don't know if she was the COO of Picor Real Estate, but she has moved up the ladder. Very impressive. And if you want more information, we will give the link about Barbi, but she has done a lot. She's currently the CEO of Cushman & Wakefield's Picor office in Tucson. I think I'm correct. Barbi, shake your head. Nobody else can see you. Thank you. In Tucson. And she's also the president-elect for CRE Network. Let me move on now to Aaron Weiner. Aaron Weiner has been around almost as long as me, which is a really long time. He's a former client of mine going back 15, 20 years or so. And Aaron is the founder and CEO of Weiner Property Services in Los Angeles. He also has the distinction of being my first guest ever on CRE radio in December of 2010. And then we have Douglas Dowell, who is, as he describes himself, an economist with a law degree. Really bright person, prolific blogger, and an experienced investor and real estate advisor. And each person is going to be giving their own little discussion, should I say. And now let me introduce my co-host, Peter Morris. He's the CEO and founder of the Greenstead Group. Peter, why don't you give a 30-second intro?
I've been in the business almost as long as you, Howard, over 40 years now, and almost. And the Greenstead Consultancy Group is an international advisory firm for commercial real estate developers, owners, investors, and occupiers. And I've had the great pleasure of working in 8 countries around the world, living in 3, including the United States and Canada, where I'm currently based in beautiful Vancouver, British Columbia. And that's about it for now. If you'd like to know more, go to the website, greensteadcg.com.
I call Peter the voice. I am envious of his voice. And he's really, really knowledgeable. He's been my co-host actually on quite a few shows, and I'm fortunate to have people. So we are now going to go to the trivia game that will be among my guests. So what they're going to do is, I guess I'm going to ask one person. I think I'm going to work in clockwise order. I'm going to ask one person. They'll have 10 seconds to get it correct. And if they don't get it correct, then the first person who raises their hand will have an opportunity to get the question correct. There'll only be 3 questions, and there are no prizes. I probably should change that. So here we go, Barbi. This is going to be
before you do it to Barbi, though, Howard, I'm going to ask you to flip back to the screen so we can see everybody's pictures and video, because I am going to find out who is going to steal the question if need be.
Okay.
So if you move to the other camera where we get all the people.
Oh, okay. Hold on a second.
I knew I threw you for a loop, Howard. There we go.
Well, I'm going to get to the questions, and everybody will be on the screen when I do that. I just don't want to let anybody know in advance what the question is, because I don't want them to cheat. And Barbi, make sure you're off of mute. You ready?
Ready.
Everybody's ready.
Okay, let's go. So this is for Barbi. Where is the Las Vegas Strip located?
Oh, this isn't like a Grant's Tomb question, is it?
That's right.
Right in Las Vegas, of course.
No. Who else knows? No hands. Come on. All right, nobody gets any. All right, go ahead.
Aaron.
Nevada.
Well, that's a good answer, and I'm going to accept that. But the question should have been in what city? So the answer to that is Paradise, Nevada. And apparently the casinos got together and they actually, I think, created a new city to avoid the city of Las Vegas taxes. All right, so the next question is going to be Aaron. All right, so the next 2 questions are going to have a little bit more of a financial twist. So Douglas may have a bit of an advantage on this. You ready to go, Aaron?
Ready.
Okay. When was the highest federal funds rate, and what was the rate? And you're old enough to know this.
Oh, gosh. Well, I would say probably the 70s. And, I take that back. The early 80s. And let's just say that the highest federal funds rate was 15.5.
That's a no. All right. It was 1980, and you were what, 35 or 40 then? Actually, I wasn't too far off. It was 1980, and it was 20%. Can you imagine that? 20% of the federal funds rate. And not only that, in 1981, while it went down initially in 1981, it went up to 20% twice during 1981. which is kind of scary. So you were so wrong. You deserve another one of those. All right, Douglas. Again, this is another financial one. Now I'm going to hopefully embarrass you on this. Here we go.
We'll see how I do.
When was the Federal Reserve formed? Oh,
I'm going to say 1913.
Oh my goodness. You got it correct. Holy mackerel.
Did you get a glockenspiel?
He's going to get applause. I made this unfair. There you go. Good job. All right. He did say he was an economist with a law degree. So now we're going to move on, and Aaron is going to give us his update on retail and industrial properties. Aaron, take it away.
Howard, thanks so much for inviting me on the show. It's great to be back after 10 years. Let's make this an every 10 years thing. Okay, I'll sign a contract for the next five decades. So really what I'm going to talk about today, Howard, is I'm not going to lay out a bunch of statistics. I look at those and I find them dreadfully boring. But really, it's more of a perspective on what's happening in those areas of commercial real estate in light of what's happening with COVID-19. A lot of people are thinking, monolithically about, well, everyone wants to get out of their lease, no one needs their lease anymore, et cetera, et cetera. And I know that Barbie's going to talk about that in particular with office, because that is really a top line issue. But with retail and industrial, it's very interesting. It's two different worlds, really. It's two different stories. With retail, the fact of the matter is with retail, yes, retail has been kneecapped by the pandemic. The kind of artificial closing of the economy obviously has just sent retail into a tizzy. The big question with retail is it's not just a matter for the rest of us of will return to normal. The damage has been so deep in some areas of retail that a lot of these businesses will never come back. So what you're going to have when we come out of this is a whole new competitive landscape, a lot less competition. And it's going to, if a third of the restaurants go away and the other 2/3 stick around, life's going to be good for them when we're out of the pandemic. If you can follow my logic. But my point is that retail and shopping centers have been undergoing seismic shifts for years now, okay? And these shifts have just been exacerbated. They've been furthered, advanced, if you will, and pushed by the stresses of the pandemic. We've heard about retailers, the Toys R Us story, which everyone followed because anyone who has kids knows who Toys R Us is. That happened well before the pandemic. And it was a function of a brand that really hadn't made the adjustments to pick up on the trends towards shopping online. There were some other problems too. They might have been over leveraged or, had gotten too far into debt and there was no righting the ship. But those situations have just been, as I said, exacerbated by the pandemic. Big retailers on the brink, JCPenney's, for instance, are pushed over the edge. But I think the lesson learned is that omni-channel, for those in the industry are familiar with that jargon, and that means that you have an online presence and a brick and mortar presence, really is the way of the future. Those people that have omni-channel are struggling but are getting by. Okay, now there are some kinds of business that you really can't have. You can't generate sales online. A restaurant can. A restaurant can use the internet to provide service to their clients. You can order online, et cetera, set up an account. They know what your favorite foods are, have things delivered at the click of of your mouse, etc. But there's some kinds of retail that don't adapt, obviously, to omni-channel, but most do. I had a client that called me up early in the pandemic. He was struggling mightily with the landlord. His business had been shut down. He owned a vintage watch store. But when I was chatting with him, and he said, he approached me, how do I go to my landlord? What are your recommendations for getting a rent break? I know how I feel, but I don't know what to say. And I was very happy to give him a hand. But I asked him about his business. And he said, he does a lot of business online. He has clients all over the world. Well, he may be struggling a little bit, but he's going to get by. So for retail, the lesson here is omni-channel. Now I'll shift quickly to industrial for a minute or two. Industrial, of the three food groups, if you will, of commercial real estate, industrial is the one sector that got a bump from the pandemic, okay? And that is, again, referring back to the retail situation, is because things had shifted online. Industrial is critical to the logistics, chain of delivering product. So the emphasis has been on last mile logistical facilities, and the news that you hear at the high level about industrial real estate, the stuff that it makes for interesting copy that the layman reads, are things like how Amazon is gobbling up, in million square foot chunks of real estate. They just can't sate their appetite. It's so huge. But that's more from an investment point of view. The values of industrial real estate for investors have not slipped a bit, and in fact, in some cases, they're going up because in commercial real estate, it's always a relative thing, and industrial is relatively more stable and more desirable now that it's doing so well, and the other two food groups are doing so poorly or are struggling so much. So that's basically
time's up.
That's basically my time.
There you go.
Pleasure chatting with you.
Oh, well, we need to move the... Well, I've got a question. I'm sure that our other guests and panelists have a question. But about 3 years ago at ICSC, I did an interview, and I was told, and I had some concerns back then, that about 50% of the new leases were food services. Everybody was, during the recession, moving towards experiential. You needed to get people out there to the shopping centers so that they could mingle and gather, right, and all of that. Now, right, obviously, that strategy was kneecapped, as you said, during the pandemic. How soon do you think we're going to get back to that, and how serious has the damage been where landlords have put in 50% of their retail into food services?
Well, all they can do now is wish that they hadn't, right? But I don't think that the trend is going away. I think that the bricks and mortar strategy for retail is the town square, is the experiential approach. So I think that food will come back, just not all the same restaurants will come back, unfortunately. But others will come along and take their places. The way I see it, and I know I'm kind of looking at it from a high level, the way I see the pandemic, the recovery from the pandemic, is we don't have to say, like polio, no one's got it anymore, it's completely gone, it's completely eradicated, now we can get back to normal. It's more of a sense of when we see the light at the end of the tunnel, when the vaccine is saving enough people and these numbers start to settle down, then I think that they're itching to get out, and I think that gradually the restaurants will open back up again. But it's anyone's guess when we're going to be sitting inside in the dining room again. A year? I don't know.
Does anybody have any thoughts about some of the adjustments that will, as things come back, what kind of adjustments are the landlords going to make. I know for one, if I were a retail landlord, I might think twice about having such a heavy reliance on food services, or, you know, what kind of changes could I make where I would be able to hedge my bet now that I've experienced a pandemic? Or am I going to take the attitude that it's once every 100 years and I'm not going to be around in the next one? Anybody?
Well,
have a comment?
I think that if I may, one of the things that happens during a pandemic is that, you know, of course, everyone in the middle of it says, oh my God, life, when we come out of this, nothing will be the same. No, most everything will be the same, but certain things that we've learned, certain habits, things that we've adopted, practices that we've adopted will remain. And what I think that retail landlords will do is pay a little more attention to, is my center laid out to facilitate being able to pick up food curbside and do some of the things people are enjoying, you know, being able to grab something good, order it on the phone, bring it home, eat it hot. And so I think that facilitating that drive-by is one way that landlords will rethink their shopping centers.
I also want to add to that, if I could, Howard. I'm hearing, of course, with the change in retail, there, you know, we've long
Hold on
heard
a second,
that retail.
Barbie. Could you put yourself on mute, and I will get to you next.
So the one thing that I keep hearing from people, and I'm still getting some feedback there. Maybe Barbie's not yet on mute.
No, she's on mute. Who else is on mute? Oh, there you go.
Okay. Yeah, now we're good. Is that retail isn't overbuilt, it's under demolished. And one of the things that I keep hearing from people coming out of this pandemic is a rethink of large footprint retail and changing it off to higher density mixed use. And we're not going to be talking about the last mile anymore. We're going to be talking about that elevator ride. And as we're looking at downtown cores changing, you know, and Barbie's going to talk about this with the office, there's going to be seismic change to downtown retail as well, because we're going to see fewer people downtown. I think personally, and Barbie may back me up on this, we're going to see multiple downtowns. There won't be one downtown anymore. There'll be multiple downtowns. That will change the shape of retail as well. I think that, as Aaron pointed out, the retailers that will survive will come back stronger, will be stronger for it. I don't think all of a sudden we're going to stop going to restaurants once the numbers start to come down. We'll still go out to restaurants like we always have. And I agree with Aaron 100% that the developers are going to rethink about how they lay things out. And with mixed-use development, it just, and lifestyle shopping centers and things of that nature, it will bode more for drive-up, walk-in, pick up, drive away than the large enclosed shopping centers where you get lost in a West Edmonton Mall or a Mall of America.
Barbie, take yourself off mute.
Yeah, I was really going to tag on to Aaron's comments about the shift in retail, and it's like what we've seen. Some restaurants have done better because they have food that travels well. So then it's a shift from the retailer side and the restaurateur side on meeting market demands, and the rise of ghost kitchens and fewer front of house staff, but more ability to create food that travels or can be picked up and taken out. And some of it's probably location and climate based as well. It's seasonal. You know, when the East Coast is enjoying summer outdoor dining, you know, we're all inside in the Sun Belt, and vice versa. In the winter, we're outside now. So certainly it's a shift in trends, and responsive, innovative, both landlords and tenants are meeting demand and meeting the market.
Barbie, I've got to admit, I've never heard the phrase food traveling well, but the picture that I get in mind is all these tiny little ants carrying a sandwich down the street. I guess that wasn't that funny. All right, Douglas, do you have any comments?
Yeah, I was going to chime in and agree with Barbie 100% because we are looking at suburban retail, infill type stuff, and ghost kitchen is a phrase that pays right now, I believe. That is going to be a huge thing moving forward. And if you don't have it in a center, I feel like for us in terms of looking for a value add, that's one of the first places we're going to go. In terms of adding value is putting in a nice ghost kitchen and aligning with folks that are interested in that type of delivery system.
Outstanding. We're going to move on now to Barbi's little discussion here, and she's going to be summarizing some of Cushman & Wakefield's work on the future of office. So Barbi, take it away.
Thank you, Howard. Just to kind of clarify my role and how we relate to Cushman & Wakefield, we're really fortunate to be part of their Alliance program. We're an independently owned, locally owned office that started as Picor Commercial Real Estate 35 years ago in Southern Arizona. And we've been aligned with Cushman & Wakefield since 2008. And it really is the best of both worlds for us and our clients. We can leverage their talent and resources around the globe for our clients' benefit and our employees, but maintain our local autonomy. So Cushman & Wakefield has been out front on research and intelligence related to the pandemic and workforce because of their global footprint. They saw and experienced with the amount of square footage that they had under management in China and the number of employees they had on the ground, what was coming, and were able to give some early indicators for that. And so I can put in the comment section a link to Cushman & Wakefield's research paper when I'm done talking, but you can also go to cushmanwakefield.com and navigate to it pretty readily. But what I'm going to be speaking from is really part 3 of a four-part series that they've developed related to advancing and moving through the pandemic and what's next. Tying also to what Aaron said, it's really an acceleration of trends, and I've heard this both in a couple of ULI presentations and elsewhere, but in addition to this acceleration of the trend of retail moving online and home food delivery, this changing workspace trend, I can tell you from my early years of being involved in BOMA in the late 80s that when I started my career in property management, they were talking about the demise of the office building because of hoteling, and we heard about the retail Armageddon, and these shifts they feel seismic when they're upon us, but they really are opportunities to innovate and for nimble practitioners and nimble businesses to succeed. With regard to work from home, some of the themes in this report from Cushman & Wakefield, they've really covered both the impact of work from home on productivity and office use with some case study, as well as focus group results that are pretty interesting. I won't bore you with the detail, but it's pretty easy to skim. And the other trend that Howard was, or one of you was alluding to earlier on, is there going to be a flight from cities? And does that mean that there's a rise of the suburban markets over the urban markets? And so there's some commentary and some forecasting on that, as well as what we can expect to see with shift in absorption. One of the things that was most interesting to me in this report was some research that was done in conjunction with George Washington University on both worker satisfaction and productivity based on the number of days of work from home. And it's pretty, well, just the short story there is that the sweet spot is probably 2.5 to 3 days a week of work from home being most optimal. But it also calls for the need for flexible work options and for retention of office space to meet that demand. And there are some pretty stunning statistics when the mathematical models are run on locating team members at the same time in your workspace, and the percentage of time, how quickly it declines when you go from 100% in the office to half a day, one day in increments, to see how hard it is to get 50% of a team located in the building at the same time. So it requires a lot more intentional management to make some of those things happen. Let's see if I can just hit some highlights for you in the time that we have left. Some of the consensus that the focus groups came to is that the future is hybrid. This need for both workspace and the ability to have flexible work from home. Employees see that as a perk. 100% remote work will be rare, and that really varies based on type of industry. Flexibility within the building is important. Flexible office offerings so that tenants can expand space on demand. We saw that in some of the co-working options that have risen in recent years. Also layout changes and the dreaded FOMO, fear of missing out, being an influencer in choice, that employees don't want to miss out on what's happening in the office when they're at home. And I think one of the other key takeaways for me from some of the earlier research from Cushman & Wakefield was that we expected when this pandemic happened for the younger employees to really embrace work from home. And the opposite was true. In higher numbers, younger employees missed being together, found it harder to be productive in their home environments. And that was a bit of a revelation. So that's a pretty quick, broad brush on what's in that report. And again, I'll put the link in the comments.
Barbi, why don't you send me the link via email, and I'll put that into YouTube and on my website. Anybody have any questions or comments? Go ahead, Aaron.
Yeah, Barbi, I'm curious what you and your cohorts at Cushman & Wakefield are thinking about these trends towards, the new paradigm, the new no-touch paradigm in office buildings. I mean, I myself realize temporarily that's very important to some people, but they're talking about, the whole trend towards amenities and communal spaces was a terrible idea. We're abandoning that, and now everyone's going to walk around in a plastic suit and can call the elevator from their phone. Your thoughts?
These are probably more my personal thoughts than Cushman & Wakefield's, but maybe they're informed by some of what I've read and heard. I think that when you have crisis, there's a tendency to kind of swing the pendulum one way and then kind of settle into a happy medium of what's practical and what's really desirable and what's affordable and brings value. So I don't see it going to an extreme. I do see some more attention to the kinds of innovative surfaces and design elements that can ensure workplace health. And that's great. That's another acceleration of trend that's important and wise. But in terms of use of space, I think maybe some of those common areas will be, they'll certainly be needed and wanted as people want and need to gather, those water cooler discussions, the ability to collaborate. And maybe they'll be larger than they've been in the past because you need to take spacing into consideration. So that's one of the things that may offset the fear that office absorption is going to decline rapidly.
Anybody else have any other comments? Okay, if not, I have some. A couple of things. FOMO, I've never heard that before. That is kind of like food that travels. FOMO, fear of missing out. When I've been in house counsel, I've wanted to be in the office where the other C-level executives were, because the CEO or the CFO or the head of marketing, they would always walk across the hallway, come into my office, pull me into meetings, and I have a fear of missing out. So when I've been in house,
in the room where it happens, Howard, the room where it happens.
Absolutely. And for an in-house attorney, that is huge. Now, understand that this happened when I traveled 50% of the time and they didn't have the internet. But when they knew I was going to be in the office, they were in my office all the time, pulling me into meetings. And it's the way that I worked as an in-house lawyer. That was really important. The changing of communal space, I really don't see that happening too much. I expect that we have maybe 6 months to a year of still being affected, more like a year still being affected by COVID. But as that starts waning, communal spaces, big atriums, etc., are going to be, and plus the height is so high, people are going to get more and more comfortable, and the cost of changing that should be astronomical. So I don't see any changes, but I do have concerns about elevator use. My experience has been, after living in California, going to high-rise buildings there, and living in New York, there's a definite difference in people's personal spaces. In New York, if an elevator holds 25 people, that elevator door will remain open until 35 people have squeezed in. In California, if the elevator holds 25 people, once 4 people are in, they'll let the elevator door close because they don't want too many people in. And that's only gotten exacerbated at this point in time. So I have concerns about the high rise in the urban cores. I see that people are there's going to be a hangover that people's personal spaces have expanded. I mean, I've noticed that myself. Wherever I go, it used to be, I don't care if someone's brushing up against me. Now, it's like, if you get within 10 feet of me, my hand's up. And that's not talk to the hand. That's like, don't get too close to me. And it's instinctive. So I see that only slowly diminishing. No other comments? Oh, take yourself off mute, Aaron.
Sorry about that. I do have one more
Put
question
yourself
for Barb.
back on mute. I'm teasing you.
First of all, I didn't know. I too came from a property management background. So my question to you, the little property manager in you that will live on forever. One of the things, I'm not involved in managing property anymore, but I wonder if the new standards for cleaning is more like a hospital than an office building. What is that going to do to operating expenses, and how is that going to impact rent structures? Or is that also maybe a temporary thing to get us through this next year?
Yeah, it's a great question. It's certainly been at least a temporary thing, and it's impacting NOI. Although it's been offset by often lower utility costs because the occupancy in buildings has been down. So I'm not sure on a temporary basis it has a huge effect, but going forward, some of the return to quote unquote normal, again, that's that pendulum swinging. Probably it's going to settle somewhere in the middle. And it will depend on the nature of the property, high rise or garden office, and yeah.
And I was going to add to the discussion, maybe ultraviolet might offer some good solutions on that. I haven't seen the full data on that, but it seems to me there's some hope that some scientific use of ultraviolet cleaning solutions might help us out a long way down that road without a huge cost attached to it.
Yes, and there's some nanoseptic materials too. We've got this great tape on our door handles, and it's magic.
And I think the other thing to throw into the mix there, we can't forget that in the short term, and I'm not talking the long term, but in the short term, we will have diminished capacity. And so you're going to see the rise of daytime cleaning. You're not going to be cleaning all of the surfaces all of the time. There will be fewer surfaces to clean necessarily at any given point in time, given the loading in a particular office. For an example, I know of one office, and they're going down to, it housed 300 people. It's going down to 189 desks to house those 300 people, and just by rolling over. So at any given point in time, they're looking at just over 50% capacity. So I think that will have a little bit of an offsetting factor to the cleaning costs. A question for both Aaron and for Barbi, if I may. From a lease structure standpoint, what are you seeing? I'm being told by landlords and by occupiers in the retail hospitality sector, short-term leases with multiple short-term options, no incentives, take over the space as is. You can't get financing, so there's going to be very little debt on these particular pieces of property. What are you seeing in retail hospitality? I'll leave industrial to one side because it's a different animal. It's still working. What are you seeing on the office side?
I am designated broker, and I approve and review all of our contracts, and the length of term has shot down. It's just been, and that's frankly, across office, retail, and industrial. Even the industrial users are doing shorter term deals. That's primarily in the smaller multi-tenant incubator type space, but not what you're seeing in some of these distribution and last mile, but it's been 6 month to 2 year leases.
Wow.
In the office world.
That's pretty typical of a recession and a time when there's a certain amount of uncertainty.
Sure.
And we've seen it, I don't know how many
nailed it,
recessions. Yeah, that's kind of what we've seen. Michael Simpson asks, the tape Barbi mentioned that cleans. Do you know?
It's nanoseptic, and it doesn't clean. I think it actually repels. I'll look it up. I'll send you that one too, Howard. You can put it on YouTube.
Yeah, I might mention, Michael, that that was in a way part of one of the trivia questions that I asked on an earlier show. The metals that are antibacterial. So the metal that is most antibacterial, silver being one of them, but it's not the most. Does anybody have any idea what the most antibacterial? Yes, you would know. And it makes
I was on
sense.
the podcast.
That's right.
I was on the webcast, so I know.
And what was it?
Brass.
Of course. That's why you see brass doorknobs. Duh. How do you like
Why
that?
it was used all the way back into the Middle Ages with the bubonic plague.
That's right. Absolutely. I could talk about that. I don't go back that far, but I could talk about it.
Well, one of the issues with respect to the short lease terms, here's another case, as Barbi and I emphasized, where there were trends already afoot and they've been accelerated. It's been really tough, at least in Southern California, with the tech startups and so forth, this idea of, I don't know where I'm going to be in 5 months, let alone 5 years. So there's been a resistance to enter into long-term leases. The problem is financial, and that is that you're not going to get landlords contributing capital to a contract that's only lasts 1 year. The other thing too is this whole idea, it's not co-working so much as it is like flexible office space. And again, necessity is the mother of invention. So people are coming up with new ways of occupying office space where you can grow, you can shrink, you can go, kind of month to month or whatever. I don't know exactly how it works. I'll understand it when I see it. But yeah, these are some of the trends that are impacting commercial real estate, and the pandemic has just exacerbated, has just sped up the progress of the evolution.
We've got to move on. Douglas, I was going to get to you, so go ahead.
Did have one point about that one. It interests me seeing how WeWork went so badly. If maybe more owners are going to elect to operate their own co-working space. And that's a really fascinating topic to me as we move forward. If operators are going to say, well, no, we're not subleasing, none of that, but maybe we'll operate some co-working space ourselves.
All right, let's move on. Douglas, we are now going to talk about your update on commercial interest rates. Let's move on. There we go.
And away we go. I'm going to try to avoid boring everyone to pieces here, but I really got fascinated in the past couple of years. We've noted that the interest rates, they keep falling. And the question is, well, why on earth is that? As we can see here, we get this graph that goes back to 2000, even before, and this is a fascinating part of it to me, this was before the the GFC. So when everything hit the wall with the GFC, maybe it's
what is the GFC? Explain it to people.
Great subprime crisis. I have a hard time with subprime crisis saying that, but before.
Good timing.
That. So it's very interesting when we're trying to look back and say, well, why is this? And that's been a topic of fascination for myself. So I kind of said, oh, okay, well. Let's go down this rabbit hole because it matters a lot. And basically the reason why I think it matters a lot to operators is, of course, when we're evaluating a property in and of itself, we dig deep into the weeds about, okay, this particular property has the NOI for this reason, and therefore it has this cap rate. But if we're going to try to look at the overall cap rate and the market cap rate, this is where the 10-year yield and the long-term interest rate becomes very important because it's basically the risk-free rate. So it sets the floor, if you will. It's the beginning of the cap rate for everyone. So it's been an area of fascination for me for a bit to say, well, let's dig into that and figure out, well, why is that dropping? And Howard, if you could slide to the next slide here. And we'll take a look at this one. This does a great job of going all the way back to 1965. And as you can see there, the long-term 10-year was around a little under 5, and then ran up. And as we were talking about earlier on the show, they shot way up. The 10-year wasn't quite as high as the Fed funds rate, but the 10-year long-term view was really quite high until the Paul Volcker came in and said, we gotta break the back of this, and indeed they did. As you can see over the 80s and since, they've precipitously, well, I wouldn't say precipitously, but there's definitely been a gradual gravity toward close to where we're at now, which with the long term, it just barely breached 1%, just I believe yesterday or today. So we're talking about a significant difference in the long-term interest rate, which is also viewed as a kind of a substitute, if you will, or a view of what is the long-term inflation outlook. And so this is where we're at. And I think what's really fascinating about where we're at, and I'm going to talk a little bit about politics only in terms of an analyst. If you had asked me before what happened in Georgia, I probably would continue to be a little bit more bearish on the long term. But I believe with a Democrat controlled government, we're going to see some pretty significant stimulus, and in fact, maybe even additional funding to directly to households. And that's why I'm really fascinated to see, well, what will that do to rates as we move forward here in the next 2 years? I think overall, I've been largely in the bear camp over the next 2 to 3 years. However, and if you'll advance to the next slide here, I think that's when we start talking about aging here. Okay, no, this one, real quick, I want to back up a little bit, which is fascinating. If you keep zooming out over time, and actually, Howard, I did want that, the next one you did show up there for me, if you would. This one here is fascinating when you look at a longer term, and we're going to use UK because they've been recording this. Basically, it's the equivalent of a long-term bond in the UK. The interest rate over time looks like it tends toward 4% over time, notwithstanding the really incredible run up from 1950 to basically the 1980s, which is really, if you will, emblematic of the growth that occurred during that time domestically in the United States, especially, but with the growth of modern economies. So as you can see there, we kind of peaked in the 80s and have since started to decline to this point. And to give a 50,000 foot view and reason and get to the more of the bottom line, let's switch to the final slide if we would, which is probably, I've resisted this hypothesis for a while, but there's a nice philosophy out there called demographics is destiny. And as you can see in the on the right-hand side, there is a very fascinating breakdown of the age groups in each country. So, for example, in the United States, as we've noted, a lot of the baby boomers have been aging. And one of the real causes of lower rates is there's just been a huge upswing in the demand for savings, both in the United States. And when I say savings, I'm also kind of equating investment as well in terms of 401ks and whatnot. So both in the United States and abroad, we've seen a huge increase in demand for investments and savings. So that's one of the number one causes of, okay, why is it continuing to decline? And then also been curious about the effect of technology. I think Dr. Schiller, who's probably one of the few economists who got the 2006, 2007 call right, so had a lot of credibility to me, offhand said, okay, well, maybe the technological cost basis of delivering products and in order to deliver products, you don't need a big factory with as much plant equipment. For example, we have services software now as a predominant part of the economy. So it makes you wonder, okay, is that one of the causes as well? So when you add the structure of the workforce and demographics, in addition to international globalization and software, you've got several things just pulling the gravity down. So for overall, that's why I've been, for the most part, been a rate bear for the most part, saying, okay, well, you have folks out there saying, well, we're printing all this money, we're doing all this, and we're going to become Zimbabwe overnight. And I've been very skeptical of that overall. Now, to present the opposite side of the case for over the next, probably I would say in the next 3 to 5 years, the question starts to become about healthcare and delivering healthcare to our elderly populations in basically the whole Western economies. You can see with that graph there that aside from China, which also is aging, aside from India and Africa, most of, including China, are starting to have a much more aged population. So to kind of sum up where I'm driving at and what my presentation was about today is to talk about, okay, why are rates really struggling to get much higher than they have been, and what do we think will happen going forward? Well, what I think is going to happen, and based on reading what the Fed has in mind, they do have a mandate of 2%. Inflation is what their goal is. They're like, oh, 2% is good. A little bit of inflation is good. But let's talk about maybe letting it overrun a little bit this time. And since we've been so low for so long, below that 2%, in the last 10 years since the GFC, they've really been like, why can't we get the inflation rate to go up a little bit? They've been struggling a lot with that concept. And so I believe they will let it overshoot a little bit. And then probably the longer term question is, well, with medical care costs, are we going to be stuck in a dilemma of, well, we have all this public debt, but we have to take care of everyone. Are we just going to let some inflation take hold? So if you want to know the bear case versus the bull case, the bull of the rates question is, well, we're just going to have to see rates go up to kind of compensate for all these other factors in the economy. So, and on a short-term basis, I did want to cover this too real quick, the short-term basis of what I think will happen. My thesis right now is everyone wants to party like it's 2022 right now. So basically, once we get across the barrier of starting to get vaccinations kick in, I really do see a pretty significant increase of cost, and I think by the time 2022 rolls around, we will see things start to normalize, and in fact, I think there's going to be a pin-up, like really expansive travel boom, I believe, and I think there's going to be some interesting things to watch with that. So to sum up what I'm driving at, and we're trying to look at right now, is I think in the near term, investors can expect pretty stable interest rates for over the next year, but we might see some the cap rate decompression, which is really the most important thing for investors. Is, are my cap rates going to start to decompress and really start to worry about, well, I came in at a certain lower cap, and if it starts to decompress on me, certain business models might not look so hot when you're trying to dispose of your assets. So that's bottom line why I've been geeking out, if you will, on what I think will happen in terms of interest rates.
Outstanding. Any questions or comments from?
I have a quick question. So, I know, and I'll speak from my home country of Canada and the people that I talk to, but it's universal. I also talk to people in Europe and in the United States as well, and everyone says, look, we're a little concerned about the dollar amount of debt that various governments are taking on, and consequently, they're saying, is it sustainable? And yet the new economists are saying, as long as the payment of that debt is below GDP, then everything's okay. I'd like to get your quick take on that.
I tend to agree that you want to keep it in some relative measure of what GDP looks like. I'm probably even a little more like flexible on that, especially given all the demographic background we're looking at. I tend to agree, though, at a certain point, it's just not like, let's run $5 trillion deficits. That's all good MMT time, which is a very, very interesting counter economic theory out there that says, well, it doesn't really matter, run all the debt you want, you'll just print more. And I'm having a real hard time with that one. So I tend to agree with, we do need to keep in some relative measure of the GDP, or else something's going to give. You're either going to accept inflation or you're going to accept higher interest rates. I don't think that you can just say, well, none of it matters, nothing matters anymore, which I fear the MMT theory of philosophy out there is basically saying that case. And I wouldn't agree with that. So that's where I stand on that anyway, for what it's worth.
Any other comments? Otherwise, we'll move on to the final trivia question for the audience. If no one in the audience answers the trivia question, then I will make it available for the first person who answers on the panelist. And if a panelist answers first, then I will donate $25 to the charity of their choice. All right? And they're not going to get a Starbucks card, unless you want the Starbucks card. And so here we go to the trivia question. The trivia question is, who created the Federal Reserve and who was President of the United States at the time? This is for the audience, and I'll give a little extra time. Come on, Michael. Look it up.
Put your answers in the chat box. Put your answers in the chat box.
Okay. You're going to get no $25 Starbucks card. All right, so should I not allow Douglas to answer this question? Barbie, do you have any idea?
Can you hear me, Howard?
I can hear you, but you're frozen in terms of your
Yeah,
video.
I don't know what happened, but I can hear and see you all too. No, I snarkily said Douglas should be disqualified, but I don't have the answer.
All right. Someone raise their hand. Barbie, or you answer. Do you have the answer, Barbie?
I do not.
Okay. Anybody else have the answer?
Well, let's see. Without Googling it, was Woodrow Wilson the president in 1913?
Holy mackerel! And who created the Federal Reserve?
Congress.
There you go. And it was Woodrow Wilson and Congress. That's kind of a trick question. Who else was going to create the Federal Reserve? So, yes, you get the $25 Starbucks card. You tell me or whether or not you want me to donate the $25. So, everyone, we are really... Tell me what you want.
Oh, I'd like you to donate the $25 to Rotary International for their good work around the globe.
Send me an email with directions, and I will make the donation in your name. So now
Wonderful.
we're at the end, and I would like everybody to tell us where they can contact you. Start with Peter.
Okay, you can reach me through that website you see on your screen, www.greensteadcg, which stands for Consulting Group.com.
Okay. Barbie, you're still frozen in time. Can you hear us?
Oh, I can. Thank you. You can find me on our company website, icor.com, or Twitter at Barbi Reuter, or on LinkedIn.
Okay. And Aaron.
I'm on LinkedIn, like everyone else here, I'm sure is. You can look me up there. My website's right below my picture. You can get my email, direct email, and my cell phone number there. And happy to chat with anyone, ask your questions, be a sounding board about what the heck is happening out there in the commercial retail and office and industrial markets in Southern California.
And let me just throw in there, as you can see on the screen, Michael Simpson was unable to answer the question, saying, sorry, the question was way above his pay grade. I doubt that, but frankly, I was very surprised that Aaron got it. He must study the presidents of the United States. Douglas, why don't you tell everybody how to get a hold of you?
Oh, yeah, definitely the very best way to interact with me is out there on the Twitter at Douglas Dowell JD on Twitter. Also on LinkedIn.
Okay, great. And I would like to finalize all this by just letting everybody know that come this Thursday, I'm going to be doing a short live stream on my 5 top tips for collecting rents from tenants. It should be about 10, 12 minutes. Then on January 21st, we have another CREtv live. And then on January 27th, we have a webinar, which is going to be on the topic of due diligence.
That's going to be a great one, Howard.
Oh, yeah. Got some really good panelists, including Peter. That's going to be a big one because going through recessions and representing lenders post-foreclosure, I had some scary, scary things that I got to see where people just didn't do any due diligence with their tenants at all and made it very difficult to collect rent. So, with that being said, I'd like to thank all of my panelists, and you have a great day, and we look forward to seeing and hearing from everybody later this week. Any other comments?
Appreciate your
Howard.
Thank you for having us on, Howard.
Yeah, Aaron, say thank you. That's an inside
Thank you,
joke.
Howard.
Peter, everyone, thank you very much. Stay safe out there. Bye-bye.
Thanks, Howard.
Bye
Bye.
now.